This is a grocery receipt, dated January 28, 2026, from a Kroger in suburban Ohio. The items are unremarkable: gallon of milk, dozen eggs, loaf of bread, pound of ground beef, bag of apples. 5 items. Basic staples that any family might purchase on any Tuesday afternoon. The total, $47.83. Now look at this receipt. Same store, same 5 items, same quantities, dated January 28, 2024, exactly 2 years earlier. The total, $31.17. The difference, $16.66. A 53% increase in 2 years for the same basket of basic goods, not luxury items, not imported delicacies. Milk, eggs, bread, beef, apples. The Bureau of Labor Statistics reported January 2026 inflation at 3.2%, supposedly within the Federal Reserve's target range, supposedly indicating that inflation has been tamed. The official number says prices rose 3.2%. The grocery receipt says prices rose 53%. The gap between official statistics and lived experience is not a mystery. It's a measurement choice. The BLS adjusts for quality improvements, substitutes cheaper goods when expensive goods are excluded from baskets, and applies geometric weighting that systematically understates price increases. The methodology is public. The result is a number designed to be low. But today I'm not going to talk about inflation statistics. I'm going to talk about what's happening in markets right now, this week, this month, that tells you the official statistics are about to become irrelevant. Because 3 assets that have never moved together like this before are all spiking simultaneously. And that correlation isn't random, it's a signal. Gold is up 47% in 12 months. Silver is up 63%. Bitcoin is up 118%. 3 different assets, 3 different markets, 3 different investor bases, moving in the same direction, at the same time, with acceleration that's visible on any chart. The last time anything like this happened, the last time precious metals and alternative stores of value spiked together with this magnitude, was 1979. And what followed 1979 was the worst inflation the United States had experienced since the Civil War. The signal is flashing. Most people don't see it because they're watching the wrong indicators. But the signal is there, in the correlation, in the synchronization, in the unanimous verdict that 3 independent markets are delivering about what's coming for the dollar. Here's what they're not telling you. Here's what they're not telling you. The correlation between gold, silver, and Bitcoin has historically been weak and inconsistent. Gold and silver move together. They're both precious metals. Both respond to similar macroeconomic forces. But Bitcoin has marched to its own drummer, sometimes correlating with gold, sometimes inversely correlating, sometimes showing no relationship at all. The 30-day rolling correlation between gold and Bitcoin averaged 0.12 from 2015 through 2024, essentially random. Sometimes they moved together, more often they didn't. Analysts who claimed Bitcoin was digital gold had to explain away years of divergent price action. That changed in Q4 2025. The 30-day correlation began rising in October. By November, it reached 0.45. By December, 0.67. As of January 28, 2026, the correlation stands at 0.89, the highest reading ever recorded. 0.89. The 2 assets now move in the same direction 89% of the time, with similar magnitude. They've become functionally identical in how they respond to market forces. Silver's correlation to both gold and Bitcoin shows the same convergence. The 3-asset correlation matrix, measuring how all 3 move relative to each other, reached 0.84 this week. A reading that would have seemed statistically impossible 2 years ago is now the daily reality. The correlation isn't coincidence. It's not technical trading patterns or algorithm synchronization. It's a fundamental convergence in what these assets represent to the people buying them. All 3 are answering the same question. What do you hold when you don't trust the currency? Gold answers, hold what humans have held for 5,000 years. Silver answers, hold what has served as money since before recorded history. Bitcoin answers, hold what cannot be printed, debased, or inflated away. 3 different answers, 1 question. The correlation tells you the question has become urgent enough that all 3 answers are being chosen simultaneously, by different investors, through different mechanisms, for different reasons, but in response to the same underlying fear. The fear is hyperinflation. Not the 3.2% the BLS reports, not the 8 to 9% that made headlines in 2022. Hyperinflation. the destruction of currency that occurs when monetary expansion exceeds the economy's capacity to absorb it. The grocery receipt already shows the early stages. 53% in 2 years for basic goods. But hyperinflation isn't linear. It doesn't proceed at 25% annually until it reaches some terminal point. It accelerates. The same forces that produced 53% over 2 years can produce 53% over 2 months when confidence breaks. The correlation between gold, silver, and Bitcoin is the market's assessment that confidence is approaching the breaking point. The investors buying all three aren't betting on any single asset's appreciation. They're hedging against currency failure across every available alternative simultaneously. This is where the lie becomes unsustainable. The official narrative says inflation has been contained. The Federal Reserve has declared victory. The rate hikes of 2022-2023 supposedly tamed the inflation that transitory policies created. But the monetary base hasn't shrunk. The federal debt hasn't declined. The structural drivers of inflation, deficit spending, debt monetization, currency debasement, haven't reversed. They've accelerated. Federal debt, $37.2 trillion as of January 2026, up from $31 trillion in January 2024. $6 trillion added in 2 years. Borrowed money that entered the economy, chased goods, and raised prices regardless of what the BLS reported. Annual deficit, $2.1 trillion projected for fiscal 2026. Money the government spends beyond what it collects in taxes. Money that must be borrowed, and increasingly, money that must be monetized by the Federal Reserve when foreign buyers reduce Treasury purchases. Interest expense, $1.12 trillion annually, more than the defense budget, approaching Social Security as the largest federal expenditure. Money that services existing debt without reducing it, a growing burden that compounds as rates remain elevated. The mathematics are not sustainable. Everyone who examines the numbers reaches the same conclusion. Either spending cuts dramatically, politically impossible, taxes increase dramatically, economically destructive, or the debt is inflated away, historically inevitable. The paper versus physical distinction applies to this analysis with full force. Paper assets, cash, bonds, any claim denominated in dollars, lose value as dollars lose purchasing power. The $31.17 groceries that became $47.83 groceries represent a 34% decline in the dollar's purchasing power for those specific goods over 2 years. Physical assets, gold, silver, land, commodities that exist independent of currency, maintain value in real terms even as their nominal prices rise. Gold at $3,150 per ounce isn't more valuable than gold at $1,800 per ounce. The gold is identical. The measuring stick, the dollar, has shrunk. Bitcoin occupies a unique position in this framework. It's not physical in the traditional sense. You can't hold Bitcoin in your hand, but it shares the critical property of physical assets, fixed supply that cannot be expanded by institutional decree. 21 million Bitcoin, forever. The code that enforces this limit cannot be changed without consensus that will never exist. When dollars multiply but Bitcoin doesn't, Bitcoin's dollar price rises to reflect the dollar's declining purchasing power. The correlation between gold, silver, and Bitcoin is the correlation between assets that cannot be printed and the currency that can. The three assets disagree about many things: physicality, history, technical properties. They agree about one thing: they're not dollars, and not being dollars is increasingly valuable. When institutions do what they're doing now, they're not making investment decisions, they're making survival decisions. At 10:30 a.m. Eastern on January 27, 2026, Fidelity Investments published a research note titled Portfolio Positioning for Currency Regime Uncertainty. The note, distributed to institutional clients managing combined assets exceeding $4 trillion, recommended meaningful allocation to hard assets and alternative stores of value, including precious metals and digital assets, as a hedge against scenarios involving accelerated currency debasement. Accelerated currency debasement. That's Fidelity's language for what the grocery receipt shows. Dollars buying less, prices rising faster than official statistics admit, purchasing power eroding in real time. The note recommended allocations of 5 to 10% to gold, 2 to 3% to silver, and 1 to 3% to Bitcoin. Combined, 8 to 16% of portfolio in assets that hedge against dollar debasement. For Fidelity's institutional client base, that recommendation translates to $320 to $640 billion in potential allocation to hard assets. Fidelity isn't a fringe voice predicting hyperinflation. Fidelity is the largest retirement services provider in America, managing assets for millions of workers whose pensions depend on prudent positioning. When Fidelity recommends 8 to 16% hard asset allocation, they're telling you what their analysis concludes about the dollar's trajectory. The note didn't use the word hyperinflation. The word is too alarming for institutional research. But the recommended positioning is hyperinflation positioning, the allocation you'd make if you expected currency to lose substantial value over a relevant investment horizon. BlackRock published similar guidance on January 28th. So did State Street. The three largest asset managers in America, combined assets exceeding $20 trillion, simultaneously recommending increased allocation to assets that benefit from dollar weakness. The correlation in their recommendations mirrors the correlation in the assets themselves. Gold, silver, Bitcoin moving together. Fidelity, BlackRock, State Street recommending together. The signal is consistent across markets and across institutions. Less than 60 days remain before Q1 2026 rebalancing, the window when institutional allocation decisions adopted during policy reviews actually execute. The recommendations published in January become purchases in March. The capital committed in research notes reaches markets in the spring. The demand that's coming for hard assets isn't speculation. It's documented in research notes, filed in regulatory amendments, committed through institutional decision-making processes that take months to complete but years to reverse. The countdown to this demand hitting markets is the countdown to price appreciation in the assets that demand targets. Gold, silver, and Bitcoin, all three, simultaneously, as the correlation predicts. While American institutions prepare, foreign holders of dollars are already exiting. At 7 a.m. Beijing time on January 29th, 6 p.m. Eastern the previous day, the People's Bank of China published its monthly foreign exchange report. The report showed continued reduction in U.S. Treasury holdings. $14.2 billion sold in December 2025, bringing total holdings to $684 billion, down from $1.1 trillion in 2021, down from $867 billion in January 2025. A reduction of $183 billion in 12 months, $500 million per day on average, every day, for a year. China isn't just reducing treasury holdings. China is converting dollar assets to non-dollar assets at a pace that accelerates quarterly. The destinations for this conversion: gold, official reserves increased 18 consecutive months, commodity stockpiles, strategic reserves at all-time highs, and, through less visible channels, Bitcoin and other digital assets. The BRICS bloc's January summit produced a statement that Western media largely ignored. Member states recognize the importance of reducing dependency on any single reserve currency and commit to developing diversified reserve strategies, incorporating hard assets and digital innovations. Hard assets and digital innovations. Gold and Bitcoin, in diplomatic language. The nations representing 46% of global population, 35% of global GDP, and 40% of global commodity production are explicitly committing to reducing dollar holdings in favor of the same assets spiking in correlation right now. The foreign selling of dollars isn't driven by speculation about hyperinflation. It's driven by observation of American fiscal policy. The $37 trillion debt, the $2.1 trillion deficit, the $1.12 trillion interest expense. Foreign holders see the same math American institutions see. They're reaching the same conclusion and acting on it faster. Each dollar sold by China enters circulation. Someone else holds it, at least temporarily. But the sale itself signals reduced confidence that holding dollars preserves value. The signal spreads. Other nations reduce holdings. The dollar's status as unquestioned reserve currency erodes, not through dramatic collapse, but through gradual, persistent reduction in foreign appetite for dollar assets. The gold, silver, and Bitcoin correlation captures this erosion in market prices. As foreign holders exit dollars, they enter alternatives. The alternatives appreciate. The correlation tightens as all alternatives move together in response to the same underlying dollar weakness. This is what a system looks like when it approaches monetary crisis. The correlation between gold, silver, and Bitcoin isn't caused by any single factor. It emerges from the convergence of multiple factors: fiscal unsustainability, foreign selling, institutional repositioning, retail flight from currency, central bank accumulation, all pointing in the same direction. The trap has no exit that preserves dollar purchasing power. The debt cannot be repaid without currency debasement. The mathematics are clear. The deficit cannot be closed without political will that doesn't exist. The interest expense cannot be reduced without either default or inflation that reduces the real burden of outstanding debt. The Federal Reserve faces what economists call fiscal dominance, a condition where monetary policy must accommodate fiscal policy regardless of inflation consequences. When interest expense exceeds $1.1 trillion, the Fed cannot raise rates high enough to slow inflation without bankrupting the Treasury. The constraint forces accommodation. The accommodation fuels inflation. The inflation erodes currency value. The 1970s parallel that analysts increasingly reference wasn't resolved through monetary policy alone. It required Paul Volcker's willingness to accept severe recession, unemployment exceeding 10%, prime rates exceeding 20%, to break inflation expectations. The pain was intense but brief. Currency stability was restored. The 2026 situation lacks the conditions that made Volcker's solution possible. Debt to GDP in 1980 was 35%. Debt to GDP in 2026 is 125%. The fiscal space that allowed Volcker to impose economic pain doesn't exist. Severe recession today would crash tax revenues, explode deficits further, and potentially trigger sovereign debt crisis rather than resolving inflation. The trap is real. The exits are blocked. The correlation between gold, silver, and Bitcoin reflects the market's assessment that the trap will be resolved through currency debasement, the path of least political resistance, the path of least short-term pain, the path that has been chosen in every comparable historical situation. The hyperinflation signal isn't a prediction that hyperinflation will definitely occur. It's recognition that the assets that benefit from hyperinflation are all moving together, being accumulated by the same institutions, recommended by the same analysts, favored by the same foreign holders, as if hyperinflation were the base case scenario rather than an outlier risk. The positioning is the signal. The correlation is the signal. The behavior of sophisticated capital is the signal. The grocery receipt, $31.17 becoming $47.83 in 2 years, is the signal that ordinary people experience every day without connecting it to the market moves that explain it. All the signals point the same direction. The assets that preserve value through currency crisis are spiking together. The correlation that never existed before exists now. The institutions that manage trillions are repositioning in real time, those who understand the signal position accordingly. Physical gold, not ETF shares, not unallocated accounts, but metal in possession or allocated storage. Physical silver, same constraints, same reasoning, same preference for possession over claims. Bitcoin in self-custody, keys you control, wallets you manage, assets outside institutional intermediaries. The distinction between paper and physical becomes operationally critical when currency crisis arrives. Paper claims depend on counterparties honoring obligations. During crisis, counterparties fail. The claims that seemed equivalent to assets prove to be something less. Physical possession depends on nothing except your own custody. The gold in your safe doesn't require COMEX delivery. The silver in your vault doesn't require LBMA settlement. The Bitcoin in your hardware wallet doesn't require Coinbase compliance with withdrawal requests. The correlation between gold, silver, and Bitcoin is a correlation between assets that can be possessed, not claimed, not held through intermediaries, possessed. The market is telling you that possession matters, that the era when claims were equivalent to assets is ending. The 2026 hyperinflation signal is not a calendar date when hyperinflation begins. It's a recognition that the conditions for hyperinflation are assembling, that the market is pricing this assembly into asset correlations, and that the window for positioning closes when the conditions manifest. The window is measured in months, not years. The institutional flows documented in research notes execute in Q1. The foreign selling documented in central bank reports continues monthly. The correlation that emerged in Q4 2025 tightens further as 2026 progresses. Reality asserts itself through price signals that aggregate information no single analyst possesses. The gold price incorporates what gold buyers know about currency. The silver price incorporates what silver buyers know. The Bitcoin price incorporates what Bitcoin buyers know. The correlation incorporates what all three buyer communities know collectively, knowledge that converges on a single conclusion. The dollar faces structural pressures that will erode its purchasing power substantially, possibly catastrophically, within timeframes that matter for current investment decisions. The grocery receipt tells you the erosion has already begun. The official statistics tell you the erosion is contained. The correlation between gold, silver, and Bitcoin tells you which information the market trusts. The market trusts the grocery receipt. The market trusts the fiscal mathematics. The market trusts the behavior of institutions and sovereigns who are exiting dollars for hard assets. The market doesn't trust the official narrative. The market is repositioning for a world where the official narrative proves as reliable as transitory inflation proved in 2021, a story told to manage expectations rather than describe reality. The hyperinflation signal is flashing in the correlation. 3 assets, 3 markets, 3 different communities of holders, all spiking together, all responding to the same underlying fear, all preparing for the same potential outcome. You can dismiss the signal. You can trust that the Federal Reserve has everything under control, that the debt will somehow be managed, that the grocery receipts' 53% increase is an anomaly rather than a trend. Or you can see what the correlation is telling you, what the institutions are doing, what the foreign holders are doing, what the grocery receipt confirms about what's already happening to the dollar. The signal is flashing. Gold up 47%, silver up 63%, Bitcoin up 118%, correlation at 0.89. 3 assets, 1 signal. The same question being answered 3 different ways by 3 different markets. The question, what do you hold when you don't trust the currency? The correlation tells you the question has never been more urgent. The grocery receipt tells you why. The next 8 months will tell you whether you understood the signal in time, or whether you dismissed it until the correlation proved prophetic. The assets are spiking. The signal is clear. The window for positioning remains open, for now.